Hi, let's just assume you have some surplus amount of money which you're looking to invest in a mutual fund so that this investment can grow big enough to cover the expenses of your future. Now, you might have looked for the perfect mutual fund on the internet and you were bombarded with a million different options. But you are still not sure which one is perfect for you, or should I say, which type of mutual fund would be right one to meet your financial needs. You might have asked about this to your friends and colleagues, and all they did is confuse you even more. Let's just take a break here and gradually analyze each point of these investment schemes to find the mutual fund of your dreams. I'm sure most of you know what a mutual fund is, right? But for the uninitiated, let me summarize this very quickly. It is a trust that collects money from a number of investors who share a common investment objective, which is to make profit. The money pooled in by a large number of people, or you can call them investors, is what make up a mutual fund. Who are these investors? People like you and me, people who don't have crores of rupees to invest. Then, this fund invests the money in equities, bonds, money market instruments, and other securities. Each investor owns units, which represents a portion of the holding of the fund. The profit generated from this fund is distributed proportionately amongst the investors after deducting certain expenses, such as expenses that are required to manage the fund, because this fund is managed by a professional fund manager. Which one should you go for? Now that we have gotten the basics out of the way, we should come to the most important question. Which mutual fund category should we go for? Mutual fund investments are not all about market risks. While the risks create intermittent opportunities to invest in low markets and make higher profits, they also provide opportunities for the regular investors like us to invest in equity oriented mutual fund schemes through the systematic investment plans or SIP to make really good money in the long term. So, here are the top categories you should go for. First, we have equity funds. Equity funds or the equity oriented mutual fund schemes that have at least 65% investments in equities or equity related instruments at any point of time, which may be increased up to 100%. Due to its high equity exposure, such funds get most affected by market fluctuations and are considered very risky. However, by withstanding the short term fluctuations in capital invested, an investor can get superior returns in the long term. Why equity funds? Equity is the only asset class that has the capability to beat inflation comprehensively and has the potential to generate long term wealth. Portfolio composition. The portfolio of an equity fund mostly comprises of stocks of different companies and equity related instruments. Investment duration. As equity funds have high market exposure, the capital invested in such funds fluctuates in the short term. To withstand such fluctuations, you should invest for more than 3 years. Higher the investment period, lower will be the risk and more will be the prospect of generating great returns. Number two on the list is ELSS. An ELSS fund or an equity linked savings scheme is a special subcategory of equity funds that provide investors tax benefit under Section 80C of the Income Tax Act 1961. You can claim a tax rebate of up to 1.5 lakh and save up to rupees 46,800 a year in taxes by investing in ELSS mutual funds. But this one has a lock-in period of 3 years and it is the shortest among all section of ATC investments. ELSS mutual funds allocates its assets mostly that is around 65% of its portfolio towards the equity and equity linked securities such as listed shares. They may have some exposure to fixed income securities as well. Why ELSS? They offer tax deduction of up to rupees 1,50,000 a year under Section 80C provision. Investing in ELSS fund gives you the twin benefit of tax deduction and wealth creation. You can invest any amount in ELSS. There is no upper capping, while the minimum investable amount varies across fund houses. ELSS funds are the only tax saving investment with the potential to offer inflation beating returns. The only thing that could be a slight disadvantage to a few investors is that ELSS funds come with a lock-in period of 3 years and there is no provisions to make a premature exit. Your investments are mandatorily locked in for 3 years from the date of investment and you cannot redeem your holdings until the completion of this period. Portfolio composition. The portfolio of an ELSS fund mostly consists of equities, while they have some exposure towards fixed income securities as well. Investment duration. You need to have an investment horizon of longer than 5 years to consider investing in ELSS funds. The equity exposure of ELSS funds requires you to have a longer investment horizon in order to mitigate market volatility. The third on the list is debt funds. Debt funds or debt-oriented mutual fund schemes have at least 65% investment in debt securities or debt-related instruments at any point of time, which may be increased up to 100%. Due to very low or nil equity exposure, such funds get least affected by market fluctuations and are considered quite safe. Why debt funds? As the underlying papers in a debt fund are fixed return instruments having predictable return and maturity period. Such funds may be used to generate regular income. This type of funds are a good choice for those people who are looking for safe investments with relatively good returns. Portfolio composition. The portfolio of debt funds composed of fixed income instruments such as government securities, treasury bills, certificate of deposits, commercial papers, etc. Investment duration. The investment duration would depend on the duration of the underlying debt papers of different debt funds. Typically, a debt fund may be used to park money for 1 to 3 years. So basically, this can be considered for a short-term investment, which is also safe at the same time. Number 4 on the list are liquid funds. Liquid funds are a type of mutual fund that invest in securities with a residual maturity of up to 91 days. Assets invested are not tied up for a long time as liquid funds do not have a lock-in period. Liquid funds also fall under the debt fund category and have instruments with very short maturity period in its portfolio. Asset value or NAV of such funds are determined even on Saturday and Sunday, so redemptions are possible even in holidays. Why liquid funds? The primary advantages of liquid funds are low cost, low risk, flexibility, and faster processing. Since underlying assets of liquid funds have a maturity of up to 91 days, they do not experience a lot of volatility, which is why the NAV of the fund remains almost steady. This makes liquid funds low risk investments. However, it is important to note that if the credit rating of any underlying security drops, the NAV can experience a drop too. So there might be a chance of a sudden drop in NAV, which means liquid funds are not entirely risk-free. Investment duration. Liquid funds are used by many investors to create an emergency fund. These funds are exclusively for investing the surplus cash over a short duration, say up to 3 months. They offer reasonable returns at lower risk and are as liquid as savings account deposits. Since these funds are designed for investors with a 3 months investment horizon, they can be an excellent choice for creating an emergency fund. The fifth and the last one on this list are hybrid funds. Hybrid funds are mutual fund schemes which invest in more than one asset class, that is, equity, debt, or other asset classes, depending on the investment objectives of the scheme. These funds invest in a mix of different asset classes to diversify the portfolio with an aim to minimize the risk involved. Hybrid funds have the potential to generate relatively better returns than debt funds while being less riskier than equity funds. There are many types of hybrid funds. Now, if I start explaining each of them in this video, it will take a lot of time. I have created a separate video regarding the type of hybrid funds in detail. You can check the link in the description box below or click the I button above. Why hybrid funds? Hybrid funds offer diversification in your investment portfolio. It also provides stability from fixed income. Since hybrid funds are relatively stable, it offers protection from market volatility. Also, as hybrid funds invest in multiple asset classes, it benefits from different asset classes such as equity, gold, debt funds, ETFs, etc. Portfolio composition. The portfolios of hybrid funds comprised of stocks, fixed income instruments, and gold as well. Investment duration. Hybrid funds may be used for investment duration of 3 to 5 years or even for a longer duration. So these were the top 5 categories of mutual funds to consider based on your financial needs. Now, if you're not sure about how to accurately assess your financial needs or how much money you would be needing in the future, say 10, 15 or 20 years from now, I have created a different video keeping that in mind. It will help you plan your financial needs. Again, check the description or the I button for that. Now, since we have covered where to invest, your next question should be how to invest. What should be the mode of investment? SIP or lump sum? Investing via an SIP is advisable if you are not willing to take higher risk. When you invest through an SIP, you get the opportunity of investing in a fund across business cycles. This helps you get the benefit of purchasing the fund unit across market cycles. When the markets are down, you buy more units while you purchase fewer units when the markets are bullish. Therefore, over time, your price of purchase of fund units gets averaged out and turns out to be on the lower side. You will benefit from this when the markets rise as you make higher capital gains on redemption. This benefit is not available if you invest a lump sum. Investing a lump sum is not advisable unless the markets are gripped by a bearish trend and you are willing to take higher risk levels and have a longer investment horizon. In order to invest lump sum, you need to take into account two things. One, how much capital you have in your hand right now which you can invest. Number two, how low the market has gone. If both of these points are in your favor, you can go lump sum. Otherwise, you miss out on the opportunity to purchase fund units across business cycles, which requires you to stay invested for a longer than 5 to 7 years to get good returns. So that's it. You can check other videos in this channel on the same topic if you are still unsure or in doubt. Stay safe, stay healthy. Bye bye.